Okay, AET Level 2 Bookkeeping. We're getting to the business end now of the actual double entry system and how we're going to manipulate debits and credits to deal with assets, liabilities, expenses and income. I'm going to take you through some basic transactions and show you essentially what the thought process is. So we're going to start our business with £900 in a business bank account. So we know from our list that bank is an asset. Incidentally, it doesn't have to be an asset. It can be a liability. So if you are overdrawn at the bank, you will have a liability rather than an asset. But for this exercise, and in general, think of bank as an asset. It's much easier to deal with it that way. So we start our business with £900 in the business bank account. So we know bank to be an asset. Assets are debits because we've got a positive asset. So I'm going to put £900 on the debit side of bank. So you need to refer to your memorised diagram of assets, liabilities, expenses and income, and which are debits and which are credits. We know that assets and expenses, when they're positive, are debits. We know that liabilities and sales, when they're positive, are credits, just to recall that. So we know that every debit has to have a corresponding credit amount. So debits match credits. So the asset that's controlled by the business called bank is debited with 900. The business owes the same amount to the owner who's put the money in, and we call that capital. Capital is a liability. It's a positive liability. So we debit bank, we credit capital. So bank, asset, debit, capital, liability, credit. And the business is up and running and away we go. Next thing we're going to do is we're going to pay the rent, let's say £50. Now if we're going to pay rent £50, let's focus on the rent account first. Rent, expense, debit. It's a positive expense, so it's a debit. If you look at your memory aid, you'll see that on the debit side, expenses are clearly shown there. So if there's a positive expense, it's a debit. Rent, expense, debit, £50. And the money's paid using the bank account. So we are reducing the asset of bank. So the bank asset this time is reducing. So this transaction doesn't involve a positive asset. We're not getting money, we are paying money. So we have a reduction in an asset, i.e. reducing the asset. So that is on the credit side of bank, the opposite to the positive side. So again, two sides. We have debited rent, positive expense, with credited bank, reduction in asset, or reducing the asset. Okay, next transaction I think we'll do is using the bank we'll make some purchases, i.e. we'll buy some of our inventory which we're going to sell on, and we'll do that for say £120. So purchases, expense, and we're establishing a positive expense here by making the purchase. So expense, debit. There we go. And incidentally, I'm not showing any narratives or dates. Initially, I'm just showing you where the numbers go. Subsequently, we'll find that there is a little descriptor that goes with the number and the date of the transaction, or some foil to reference it. So at the moment, we're just doing the numbers because we haven't got many transactions. We can see where we are. So purchases, expense, positive expense, debit, and we're using the bank to further reduce the bank asset. So 120 will be a credit to the bank account because on the bank account, debits are positive assets and we're reducing the asset. Okay, so that's that. The next transaction we're going to do is we're going to make a purchase, but we're not going to pay for it straight away. We're going to pay for it later, 30 days, let's say, later. And the amount is going to be for, let's say, £80. So if we're going to make a purchase for £80 but not pay for it until later, then we won't be using the bank asset account. But the accounts we are going to consider are purchases expense account and payables, because payables means an amount we owe, i.e. an amount we have not yet paid. So for £80 then, we've got a positive expense, expenses are debits, and we've got a liability. We've got a positive liability. Payables, liabilities, credits. So again, two sides to the transaction. We've established an expense, debit, and we've established a liability called payables, and that's a credit. So debit purchases, credit payables. Let's now say that we make a sale and we get the money straight away into the bank, and we're going to make a sale to the amount of £300, to the value of £300. So if the money is going straight into the bank, we've got a positive asset, and the amount is £300. So asset, positive asset, must be a debit, and it's a sale. Sales, income, credit. Must be £300 there. Income in the form of sales is always a credit. Okay, so you need to keep that memory aid, that T account in your mind at all times. So we've done a bank sale there, money straight in. The next thing we're going to do is a sale where we won't get the money straight away, we won't get the money for another 30 days, and we're going to do a sale for, let's say, £100 on credit. So we won't get the money straight away. So again, we've got sales, positive sale, £100, and we're not going to receive the money for 30 days. That's a receivable. It's not going in the bank, it's a receivable. A receivable will describe amounts owed by credit customers that haven't been received yet. We've got an asset, they're regarded as assets because there is a contract. The money's not, the amount is not quite as good as being in the bank, but almost. So asset, positive asset, debit. Okay. So far we've done some sales and purchases. We've paid the rent. We could also buy, let's say, a van. Let's put a van account in, and let's pay from the bank asset to get a van asset. So we're going to transfer amounts out of the bank asset account into the van asset account to the amount of, let's say, 200. We're going to credit bank to reduce the bank asset, and we're going to debit van 200 to establish a positive van asset. So at this point we have various debits and credits on the accounts. And so what we essentially need to do is to double check that our debits equal our credits. And if we take a balance on all accounts, we'll be able to list those balances into something that we call a trial balance. So we can get a list of all these accounts with either debit or credit amounts on them. And if we add up the debits and add up the credits, they should come to the same number. Okay, so the first thing we need to do is actually balance off the accounts, which I shall do very briefly. So the bank account, to balance it off, we can see on that bank account that there is more on the debit side than the credit side. The question is, how much more? So we do a little calculation. We've got 1,200 on the debit side, but on the credit side there is considerably less than 12, so that's 1,9,880, 830. So there's 830 more on the debit side than the credit side, and so we say that the balance, or the balance carried down, is, did I say 830? And we could put that there. Okay, so that gives us a clearer picture regarding the bank account, i.e. we've got 830 in the bank. Now, what I'm going to do is create the trial balance very briefly, and we can see if we're balancing. So I'm just going to remind myself what the balances are. We can see receivables is 100. Just going to write that there briefly. We can see sales is 400. see rent is 50. So I'm just going to rub these out to enable my trial balance to work. Then I'm going to list the accounts. It doesn't matter which order. So sales, rent, receivables, I'll put those in before I forget. So the sales was 400, which I'll put there. 400. The rent was 50. Receivables 100. I can rub those out now. Now I can continue with the rest of them. We've got capital, bank. Capital was 900. Bank was 830. Van was 200. Purchases are 200. Payables are 80. And if no errors have been made, hopefully the debit will equal the credit. So let's see if they do. So we've got 1380 on the credit side, and on the debit side 830, 1000, 1230, 1330, 1380. Okay, so just a quick run through then. We've learned a basic method of applying debits and credits by recognising whether the account is an asset, a liability, expense or income. We then, by applying that rule, or those rules, we were able to debit and credit accounts in pairs, and then at the end of the period, at the end of the session, we were able to find the balances on the accounts, list those balances in the form of a trial balance to establish that the debit and the credits all added together will equal the same. Okay.